Oh yeah, it's an honor. I appreciate it.
Let's see. So we're on air. It'll allow everybody that's logged in to join.
All right. And you let me know when you want me to get started, and I will.
Okay, perfect. So it's let's look at the clock. It's 12 o'clock on the dot. Let's give people maybe like just one more minute, and then we'll go ahead and jump in, and I'll explain the platform.
Okay.
Welcome, everybody.
Welcome.
Hi, Angela. Hi, Terrence. If you see over on your right-hand side of your screen, there's a chat feature. If you want to look at that, you can chat with everybody. Wanda just said hi. Okay, it's 12:01. We'll go ahead and get started just to keep everything running on time and not waste any of your precious time, Wanda. Wanda, thank you so much for joining us. All week I've been singing the song, Help Me, Wanda, help me, Wanda, as we were trying to get people, to talk about their finances and their credit score. It's one of those things that nobody likes to keep score, or at least when you're winning or losing, it can be really tough. And so we're really excited to have you here today to sort of make, that number, if it's higher than you think or lower than you think, how to make some sense out of how they actually calculate that number, that all-telling number that a lot of other things depend on. I had the pleasure of meeting Wanda just recently. I was introduced to you through a mutual friend and mentor of mine and yours, Chuck, and he always says how to make 1 + 1 = 3. And I think by meeting you and hearing your story, which I hope you share a little bit about during this webinar, but we have that fight for people and how systems and processes are really just set up to make them difficult to navigate for the regular person. And then there's an industry that capitalizes on that challenge. So thank you today for taking the time to share a little bit more about what credit means, and how we can actually be in control of that process.
Well, first, I appreciate the invitation. This is such an honor to be able to teach your attendees today regarding credit. So I want to introduce myself. My name is Wanda Strickfaden, and I'm the owner of Improved Credit here in the Carolinas. I've actually been in the business of helping people fix their credit since 2001. So I started out in my early career as a loan processor. And in the midst of understanding credit for financing, I realized that I had no idea what was going on with my credit. So my personal experience is something that I'm sure some of you may relate to or have heard of others going through this. But once I looked at my credit report back in 2001, I realized I was a victim of identity theft, which was difficult for a 24-year-old,
Oh, wow.
Yes, it was really hard. And at that moment, I remember the feelings I was going through of just the unknown, depression, anxiety. It was just such a horrible feeling to find out that you have close to $35,000 in debt that didn't belong to you and you don't know how to resolve it. So, at that time, I hired a company to try to help me with that. And for a full year, I paid them a monthly fee. I had no results. And I thought, geez, who do I trust to help me with my credit? And I realized no one but myself. So I literally took my own experience and started just testing the waters, trying to figure out how to fix my own credit. It did take me some time because I read a lot of books about budgeting, about finance, and I ended up learning how to repair credit for 7 years. Not only did I try to help myself, but I was also helping my customers who needed loans. And at that moment, a lot of my customers were from the Spanish community. So I ended up getting an understanding of how to restore someone's credit, helping them establish credit. All of that experience really helped me through that process. And in 2009 is when I realized that I needed to transition from being a loan mortgage banker and into credit repair full-time. So that's how my career started. It's a personal experience.
Yes. And how you can actually feel the emotions that your clients are going through, when they come to you for services. It's amazing.
Yeah.
And well, let me go through these quick slides just to explain the platform. We want to make this as interactive as possible. So after Wanda finishes her presentation, if you would like to speak, you can raise your hand. It's on the right-hand side at the bottom. It says speak. And it'll guide you through a process just to make sure that your system's set up that you can chat. And then it'll hit start the test. So you hit the green button, verify that you can hear. You'll see yourself at that time. And if you only want to talk via, the chat, that's fine as well. But there is a way for you to also become a speaker. So I will turn off my video. I'll make yours a little bit bigger so we can see you a little bit better. And then I'll get out of your way.
All right. So for those of you that may not know about my business, it's called Improve Credit. I'm located here in Monroe, North Carolina, and I do have offices in Charlotte as well. We do provide services nationwide. So regardless of the state that you live in, we can provide credit repair service in that state. My website is right here on the slide. It's improvecreditllc.com. When you get a chance, feel free to visit it. You'll be able to see the different services that we provide. You'll also see some testimonials. We're in the process of having a media page, so you'll probably see this video on our website as well for future reference if you want to review it. So I want to go ahead and start the presentation by talking about the foundation of credit. So for those of you that may be interested in purchasing property in the near future, I want you to prepare yourself mentally to understand what lenders look for when it comes to qualifying you for a home loan. And if you're probably in this you're probably in attendance to fix credit as well. So I'm going to talk about how to fix it too, but this is important. So if you understand the foundation of credit, you're able to do a lot of things with your credit to improve it. So with that being said, there are 5 factors that affect a credit score. 40% of your score is serious delinquencies, public records, and collection debts that are filed on your credit report. 40% of your score is affected by those 3 things. 20% of your credit scores are affected by the number of accounts that are delinquent. So if you have, let's say, 2 active credit cards where you're paying your bills on time, but you have 5 collection debts, those 5 collection debts are going to outweigh the good with your active credit cards. So 20% of your credit score is affected by those accounts. Keep that in mind. 15% of it is the time that your delinquent was reported on your credit report. The time, meaning that if a new collection debt reports on your credit file for 2020, 15% of your credit score will be affected by that new debt. If the debt is over 2 years old, the older it gets, the less it affects your credit. It still affects it, but not as much. So 15% of your credit score is the age of that delinquency of that debt. 10% of your credit score is the proportion of balances that you have versus the credit limits with your revolving debt. So utilization is really important, making sure that you stay below a certain percentage. We'll get into that in the next slide, but I will talk to you about that. But 10% of your credit score are the balances that you have currently with your revolving debt. And then 5% of your credit score are inquiries. And inquiries means that if you allow a lender, a creditor, a cell phone company, if you're applying for any kind of service or credit card, including loans, 5% of your credit score is affected by those inquiries. They're considered hard inquiries. So those are the different factors that affect a credit score. Knowing that alone, just those factors alone, will give you a better insight of how the credit scoring system functions with FICO. And FICO is Fair Isaac Corporation. That's where the scoring system module comes from. So if you can keep that in mind, you'll be in good shape for the future. So let's talk about derogatory markings. Delinquencies can affect a credit score for up to 24 months. What that means is that if you miss a payment with your revolving debt, installment loan, or mortgage, that 30-day delinquency, the moment you're late within that month, will affect your credit score for 2 years from the date of last delinquency. And if you're wondering, well, how much does that affect you? Let's continue to talk about that. So the next thing that affects your credit is collection accounts will affect your credit as well. Collection debts will affect your credit report for up to 7 years from the date it was originally charged off. So if you have a charge off, let's say with Bank of America, and it was charged off in 2000 and let's say about 5 years ago, that will affect your credit report until 2022, for 7 years from the date it was originally charged off. If you're wondering when it was charged off, the best way to figure that out is try to verify the last time you made a payment on that credit card or that installment loan. If you can confirm that the last payment that was made was 7 years ago, then just keep that in mind, that that debt has affected your credit report for that whole time frame. But legally, after 7 years from the date it was originally charged off, you can legally get a debt removed from your credit report. It says it very clearly with the Fair Credit Reporting Act that if a debt is over 7 years old from the date it was charged off, you can legally get it off your credit file. So keep that in mind. If you have really old debt that's over 7 years or older, you can actually get it off your file. So I was talking to you about delinquencies and how that affects your credit report for 24 months. Derogatory markings, they can decrease your credit score anywhere from 1 to 2 points a month. So if you were delinquent recently within the last 2 years, that delinquency will affect you for the next 2 years. So if it's an active account, obviously payments will, the older the delinquency, the older it gets, the less it affects it. That's why I say it's within 1 to 20 points every month, because the older it gets, it'll affect your credit score less. But if it's a recent delinquency, that will affect your credit report. So keep that in mind. Late payments, they can be removed from your credit report, and for the following reasons. So keep, this in mind as well. If a creditor never mailed you a billing statement. So if you moved recently and you gave your creditor, lender, mortgage provider your current address, but they updated the system incorrectly, or they never updated it at all, but you made that phone call, that's a way to get a delinquency removed, especially if you never received the billing statement and there was something going on there. So you can always talk to your creditor, lender, or mortgage provider and work out an arrangement for them to remove that 30-day delinquency if it was their fault. If the creditor mailed your billing statement to the wrong address, that's another one. So if you did give them an address, but they typed it in wrong and they reported your account late, you can get that delinquency removed. You just have to make sure you speak to someone about that and get it removed. If you made an on-time payment, but the creditor reported it late, or the lender, mortgage provider. So keep that in mind. If you did make your payment on time and they still reported it late, it was their fault, they can remove it. I'm going to give you a little story about that. One of my customers made a payment within the grace period. So you want to look into that, because every creditor has a grace period of anywhere from 5 days from the date it's due up to 30 days, and even up to 60 days. There are creditors that will give you up to 2 months to make your payment, and they will not report it late to the credit bureau. So find out what your grace period is with your creditors, your lenders, your mortgage providers. And if you are having financial difficulty and are not able to make your payment on time, go ahead and make that payment and then contact your creditor to resolve that. All right, so I'm going to go ahead and move on to the next slide. So public records are tax liens and judgments. Anything that's on your credit report for 7 to 10 years will affect your credit report. So state tax liens, federal tax liens, and a judgment will remain on your credit report for 7 to 10 years from the date it was filed. Now, the reason why I say 7 to 10 years is because each state has its own time frame. Like in the state of North Carolina, it will affect your credit report for 7 years from the date it was either filed or discharged. So definitely look online. You can always Google, how long do tax liens judgments stay on my credit report in the state of, and it'll give you the answer to that question. Public records also includes bankruptcies. Bankruptcies will remain on your credit report for 10 years from the date it was discharged. So keep that in mind. And then each state, like I said, has a statute of limitation. Basically what that means is that if a credit card company, your landlord, a medical provider, a mortgage broker, a mortgage loan, if they decide to file a judgment against you, a lien, each state has a statute of limitation where they have a certain time frame where they are allowed to file a lien against you But after that time frame, they're not able to do it legally. So in the state of North Carolina, it's 3 years. So from the time that your account goes into a charge-off status, they have up to 3 years to be able to file a lien against you. If they exceed that 3-year time frame in the state of North Carolina and they still file a judgment against you, you can fight it. You can actually go to the courthouse, make sure that you have your paperwork ready, your facts of when that account was charged off originally. You're going to want to have that. And then you can let the judge know that that debt was over the statute of limitation. So once you have your facts, you're able to fight that to get that lien or judgment off your credit report. Let's go on to the next slide here. And I want to go ahead, if you don't mind, and talk about this next slide, but I hear something in the background. So I'm going to go ahead, if you don't mind, just give me not even 30 seconds to turn that off so it's not a distraction. Hold on one moment for me, please. The beauty of working from home, I am sure you all understand. All right, so the proportion of balances is also very important when it comes to your revolving debt. So like I mentioned before, that utilization is about 40%, actually 20% of your credit score is utilization. So be careful how much you're borrowing. So if you are over 30% of your credit limit, that will decrease your credit score. For example, if you have a Bank of America credit card and your limit is $10,000, but your balance is $4,000, over 30% of your limit, you will notice your credit scores may decrease anywhere from 1 to 20 points a month just because of how much you're borrowing on your revolving debt. So try to keep your balances low, below 30%. Credit reporting agencies are looking for balances that are below 30% of your credit limit in order for your credit scores to improve. And the credit reporting agencies look at you as a high-risk borrower if you're borrowing more than 30% of your credit limit, which will affect other lending opportunities. Payment history is important. So making sure that you make your payments on time is really important with this process. So in order to establish a good history, a consumer should have a positive payment history for at least 2 years for each account. Like I said, your credit report, when you pull it, you'll notice that it shows the last 24 months of payment history. So if it's an active account, it only shows the last 2 years of history. So keep in mind that a payment that's on time is really beneficial for you. Establishing a positive payment history, it will increase your credit score on a monthly basis. And there are other benefits too. If you're paying your bills on time, sometimes your creditor will give you benefits where they'll increase your credit limit. Or if it's a secured credit card, they'll go ahead and after 6 months of on-time payments, depending on the creditor, may go ahead and turn it into an unsecured credit card. And then basically give you more of a credit limit because of that. A secured credit card basically means is that you're depositing your own money into that account to establish credit. So usually if it's secured and you have bad credit, that's a good way to establish credit if you have no credit at all. And then depending on the creditor, like I said, if you're making your payments on time for at least 6 months, after 6 months, they'll turn that into an unsecured credit card. So you're no longer securing it with your own asset. They're giving you money now. And they'll increase the credit limit, which helps you tremendously if you can find a credit card that does that. This will give the consumer, the upper hand when choosing interest rates for a mortgage, annual percentage rates for a revolving account, and many other benefits. So, we're in a place right now, in a market right now, where I know the pandemic has affected a lot of us. And you're not really sure if this is the right time to move forward with purchasing a home. But I highly recommend that you consider purchasing property, because this is actually a buyer's market. This is your market. So don't be afraid to move forward with that option. And if you have credit issues, fix it first. And we are here to help you, of course. But fix it first and then purchase property. Don't be afraid of that. It's actually a best time to buy. It really is. So derogatory accounts, once a collection account is placed on your credit report, this will continue to affect your credit in a negative manner and decrease your credit score every month. Collection debts really are a big factor. Like I said, it's 40% of your score. So if you have a debt that's reporting on your file that's in collections and it's not over 7 years old from the date it was originally charged off, I highly recommend that you go ahead and speak to that third-party collector, verify that the bill is yours, and once you verify that it's yours, negotiate a settlement. It's always best to settle a debt that's already in collections. Some customers call me and ask me, is it better to pay off a bill in full or to settle a debt? How will that affect my credit score? And the truth is, FICO changed their system in 2011, which means that if you pay off a collection debt and it shows that it's been paid, regardless if you settle the debt for less or if you pay it off in full, it will improve your credit report the moment it shows a zero balance and settled or paid. So it doesn't matter which option you choose. I'll say to you to go to the settlement option so you can save money. And of course, always get everything in writing before you make your final payment so that you have proof. And to avoid this, you can contact the original credit or collection agency and go ahead and negotiate that settlement. Payment plans are also available. I don't really recommend payment plans when you're settling debt, just because if they give you a payment plan, they may give it to you where, you're required to pay, let's say, half of your balance, and they'll say to you, you have 4 months to pay it off. My recommendation is save the money first, half of what you owe, if you decide to go that route, and then contact them and settle and pay it off that day. Don't wait it out, because every month when a collection debt is reporting on your credit report, it will decrease your credit score. So it's best to just settle the debt so you can get a receipt and then basically update it with the credit bureau that it's been settled as soon as you possibly can. So I don't recommend payment arrangements unless you have no other option. Then obviously that is another option that you may have as well. And the next slide is inquiries. 5% of your score is affected by that. Soft inquiries, they're pulled by creditors, financial institutions, insurance companies for advertisement purposes only. Soft inquiries do not affect your credit score. So if you ever get like a statement in the mail and it's from Citibank asking you to become their customer, that's a soft inquiry. They actually were able to access your personal information with the credit bureau, which is Experian, Equifax, and TransUnion. So they bought your information from them in order to mail you advertisements in the mail. That is soft. And you may notice it on your credit report, but that doesn't hurt your credit score whatsoever. Hard inquiries, they're based on a verbal or written approval for credit cards, mortgage loans, insurance approvals, even cell phone companies. If you're applying for any of those options, those are hard inquiries and they will affect your credit score. This may decrease your credit score anywhere from 1 up to 15 points for each pull. So just keep that in mind, because that does affect your credit score, and that's about 5% of your score. All right, let's get down to the nitty-gritty, because this is the most important part of this slide, is what's available for me through this pandemic with the coronavirus. So if you have active credit cards and you haven't been able to make your payments, or you're having a really hard time making your payments, the best option you have right now is to choose a skip-a-pay option with your debtors. There are skip-a-pay options with your credit card companies, your car loan, and your mortgages. So if you have any one of those and they're active, go ahead and contact those providers immediately and enroll in the skip-a-pay option right away. So this will not affect your credit report, by the way, if you choose that route and you're approved, which, recently some of my customers applied for that and they were able to get approved within 48 hours. So what ends up happening is that your credit report will continue to reflect that you're on time with that payment, even though you skipped a payment that month. So that's a good thing. It won't show that you're delinquent. The balance that's owed, especially if it's like from a mortgage company or a car payment, it will show at the end of your installment, term, or the end of your mortgage term. So it's not a payment that is forgiven. It will be added to the remaining balance of your debt. It's not additional interest either. They're not going to charge you additional interest because of that option. So just know that you are safe in that area too. Student loans also have COVID-19 relief assistance, which is the forbearance program for all government student loans. Government student loans are obviously anything that has to do with U.S. Department of Education, with federal loan servicing. Those are all government student loans until September 30th of this year. So you do have the option to contact your student loan provider and enroll in their forbearance program right away. You have up till September 30th where you will not have to make your payment. Now, obviously, you're probably wondering, well, what do I do after September 30th? Well, the best thing to do is contact them by the end of August and enroll, if you can, if you're financially stable and you're able to do that, enroll in the income-driven repayment plan. What that means, the IDR program, is that they'll look at your expenses. So you'll want to be prepared with a budget, figure out what your monthly expenses look like. And monthly expenses includes everything, like your rent or your mortgage, utilities. It includes your credit card payments, your grocery bill, your cell phone bill, any subscriptions that you're paying for, like Hulu, Netflix, Amazon Prime. It includes everything. That's your household expense. And then you're going to want to give them your net income every month. They will ask you that. So once they verify that your net income is lower than your actual monthly expense, they will reduce the payment so that it's affordable. I've had customers enroll in that, and their payments were either $5 a month compared to what they originally would have paid for a student loan of anywhere of, from $250 to $350 a month. It was reduced all the way down to $5 a month. And other consumers experienced zero payments required in an IDR program. What's the benefit of an income-driven repayment plan? I'll tell you this right now, the benefit of it. It usually lasts for 12 months. It's a whole year. So you'll have to renew it every year. And obviously your income may change every year and may get better. So you'll always want to be prepared with your budget. And then after 10 years of an IDR program, you can get the rest of your balance completely forgiven. This is where the student loan forgiveness program comes in. Some of you may have seen this on Google, get your debts, your student loans forgiven. This is where it comes from. You have to enroll in the income-driven repayment plan. After 10 years of doing that, every year of renewal, you can get the rest of your balance completely forgiven. So that is an option, and it's a really good one. Purchase interest will continue to accumulate with your credit card accounts. Purchase interest with your credit card accounts will continue to accumulate while you're in that skip a pay option, okay? Monthly interest will continue to accumulate with your car loans. So even if you're in that skip a pay option for your car loan, your monthly interest will continue. Now your unpaid payment, like I said, will be added to the end of your installment loan and or mortgage loan. And like I said, it will not affect your payment history, nor will it affect your credit report. So those are options for COVID-19 relief. Take advantage of them right away. Now, with our program here, we can help you. So if you want to discuss your credit with us, the discussion is free. You can call us at 704-877-8739. Free to call us and let us know what's going on with your credit so we can get a better understanding. Then what will happen is we'll schedule an hour credit consultation with you. And once we schedule that appointment, we'll pull your credit report with all three bureaus as a soft pull. And we'll go ahead and begin to put together a plan to get you out of debt. And in that plan, we're going to also begin to manage your active revolving accounts to help rebuild your credit score. So not only are we going to help you fix any debts that are in a charge-off or collection status to help you become debt-free and save you time and money, we're also going to manage your accounts from now on. And with that alone, that will help improve your credit score consistently every month with our program. And we have a total of 5 programs available within our firm. We have the dispute program, which allows us to dispute anything that's inaccurate, unverifiable, meaning it's a debt, it's not reflecting accurate information, you're not sure where it's coming from, or unverifiable, you're not even sure if it belongs to you. A debt that's over 7 years old, that's part of the dispute program, or a bill that you paid for but is still showing a balance. And then, of course, we have that available too, where we'll help you with debt settlement. So the next program is debt settlement, where we've been able to save our clients anywhere from 50 up to 75% of their balances owed. That's why we're able to fix credit fairly quickly, because we're able to save our clients a lot of money with debt settlement. Debt management basically allows us to manage your debt. So if you have active credit cards and you have discrepancies with delinquencies, we'll help you resolve those delinquencies so that we can get those delinquencies to be removed, or, we'll basically help manage that so you're paying your bills on time if they are accurate. With debt management, we also will help you with contacting your creditors to help reduce your interest rates when your credit score is above 700. The Identity Theft Restoration and Protection Program is really important for a lot of our customers. If you know that you're a victim of identity theft, we will go ahead and start the fraud investigation through that program, protect your credit right away with the credit bureau, and begin removing debt that doesn't belong to you right away to help you with that. And then we also have the monthly monitoring program, and that allows us, like I said, to manage your active credit cards from now on. And we'll be able to give you monthly advice on how much to borrow and how much to pay off on your credit cards so that you can experience an improvement with your score. And in that program, because you get an email from us every month, if you have questions regarding anything, if you're interested in renting an apartment, we have all the answers regarding how to get approved for that. If you have questions regarding a mortgage loan, we have connections to refer you to a mortgage broker to get you pre-qualified and a real estate agent to help you with your real estate needs. So basically, when it comes to financing options, we have all the answers to your questions regarding anything in that category. So those are our programs, our process, and I want to take the time to see if anyone here has questions that I can help answer. And if there's any way that Lindsay would be able to get back on with me so that we can kind of do it together, that would be great.
Here I am. Ask. There were a couple questions that popped up in the chat bot. One of them was from Terrence about check systems. Are you familiar with check systems?
Yes. So check systems is a systems that banks, credit unions work with whenever you have an unpaid checking account, savings account, or over limit account. So if you have a debt with a bank, it's going to report with check systems. They will give you the phone number. So all you have to do is just contact the bank and they'll give you the phone number for check systems. And basically the same thing, just like if you're contacting a credit card company to negotiate a settlement, a collection agency regarding a debt, or your mortgage, provider, if you're trying to work out a payment arrangement, the same thing will happen with check systems. You want to call them and negotiate a settlement. So if you owe $500 for an unpaid checking account, you can settle the debt for half of what you owe, if not less than that, by letting them know that financially you can't afford it because of what's going on with the pandemic. And they will go ahead and approve it. You just have to make sure that you're speaking to the right person. It may not happen with the first person that answers the phone, so you may have to talk to management. But once you get it approved, get it in writing first. Have them email it to you or mail it to your address, and make sure they give you up to 30 days to pay that bill, because it may take 5 to 7 days before you get that settlement approval letter. And then once you get that, pay it.
Got it. So you want to make sure that you have it in writing before you send them any money.
Always.
Got it. That's really important. Chuck had a question about medical. So what can you do if a doctor or hospital charges you more than what your insurance company covers, or you're uninsured?
The best thing to do is talk to the billing department with a medical provider. So if you went to Novant Presbyterian and you have a bill with them, you're going to contact the hospital and ask to speak to the billing department. Once you go to that department, they will ask you for your account number. You may not have it at that moment, so you can always give them your social security number to pull up the account. But once they pull up the account, you can verify that that bill belongs to you, confirm that your insurance provider paid their portion, and whatever the remaining balance is, negotiate a settlement. Now, at that moment, you may not be prepared for a settlement because you're just calling to ask questions regarding your balance. So if you're not prepared, then go ahead and figure out how much you owe the hospital or the physician, and then prepare to settle the debt by saving about half of what you owe. And like I said, you can always try to settle the debt for less than 50%, but at least if you have half, you have something to work with. And then you can contact them again and negotiate a settlement. lower than 50% and see if you can get that approved. And like I said, before you make that payment.
And I'm just curious, when you have a medical bill related thing and you file for bankruptcy and things like that, does it ever get discharged? I think, isn't there some issues with that? That's why people, if they end up getting sick, they have a tendency to, kind of just create this hole for themselves that they can't get out of.
So with bankruptcy, and again, I'm not a bankruptcy attorney, so I do have to put that out there, but I will give you my opinion.
Okay.
But there are different bankruptcies. There's Chapter 7s where Chapter 7 bankruptcies completely forgive your debt. And then there's Chapter 11 where it's a repayment plan, and a Chapter 13, which is also a repayment plan. Chapter 11s are for businesses, but Chapter 7s and 13s are for personal consumer debt. So depending on the chapter, if it's a Chapter 7, all of your debt will be included, excluding student loans.
Oh, okay. Student loans. Got it.
Yeah. So if you have medical debt, it will be included in a Chapter 7 bankruptcy. You won't have to worry about that.
Okay, gotcha. That's helpful to know. Mary asked a question: is CreditRise and Vantage Score just as reliable as Equifax?
What a great question. Honestly, the third-party websites online, the only thing that's reliable when it comes to pulling credit is the debts that are on your credit report, but the scores are not reliable. Because what you'll notice is that Credit Karma uses a different system, which is through TransUnion, and it's called Vantage Score. They have their own scoring system. It's free. It's great to have, but the scores are very different than if you're going to your lender to pull credit. They're pulling it through FICO. With Fair Isaac Corporation, the scores bank, they may be anywhere from 50 up to 100 points lower than what Credit Karma is reflecting. And then if we're going to compare Credit Karma to other bureaus like Experian.com, Equifax.com, or TransUnion.com, you'll notice Credit Karma scores, they have their own scores compared to those three websites. Each third-party website has their own score. So really, the scores online are a reflection of the category you're in. So for example, credit scores that are between 300 and 639 are considered poor. Credit scores that are between 640 and 679 are considered average. 680 to 699 is considered good. 700 to 850 is considered excellent. So depending on the category that your credit score is on will depend on the financing options that you have available, but at least you'll know online what category you're in. So if you're going to stick with pulling your credit report with Experian.com, stick with that website, because if you're going to compare that to Credit Karma, it's going to confuse you. You'll notice with Credit Karma 1 month that maybe your scores improved 50 to 70 points, but then Experian that same month shows that it decreased 20. So just stick with one service provider. And it's best that you stick with like the credit bureau itself and not Credit Karma. It's a good thing to have because it's free, but those other services that they provide online is also very good as well. It at least gives you an idea of what's happening to your credit scores if you're looking at one source every single time.
Got it. And then that way you can see it kind of over time, the trending points, and say, I need to see what's going on there. Chuck has another question. Are there still laws limiting interest rates that you can be charged?
Say that one more time.
Are there still laws that limit the interest rates that you can be charged?
No. So the Fair Debt Billing Act, there is a cap. Every creditor has a cap when it comes to interest rates, right? Definitely look at your statements to figure out what that cap is. What's shocking to me, though, from my experience, is that a credit card interest rate is higher, is really just ridiculously high, like up to 29.95%. I've seen it that high.
Wow.
And
how do you pay off that? Yeah, that's crazy.
You don't. It's hard. If you have like a $10,000 balance and they're charging that type of interest, it's like basically paying for a mortgage. It's going to take you 30 years to get out of debt. So I highly recommend that you're very careful when you're applying for revolving accounts, that you wait till your credit scores are above 680 and you're debt free before you apply for credit cards, so that you have the best interest rates, the best terms, and you're saving money.
I like Damien's question. I was the queen of balance transfers for a while, because when I was 25 and started avocations, I always say I started with a dream and a credit card. And that Discover card ended up, costing me a lot of money. But I used the balance transfers as a way of getting, 0% interest. Yes, I might pay a 3% or a 5% fee, but it was my only way of getting the APR at a point where I might actually be able to like pay more than just what the interest was charging me. So what are your thoughts on balance transfers and things like that?
Here's the best you can do for yourself. When you open up a credit card and you're considering balance transfers, always keep the account that you paid, that you basically transferred from, open. Even if you decide not to use it, never borrow from it again. Don't close it. Because the thing is the moment you close out an active account, you lose all of that positive history that you've built with that debtor.
Oh.
And it decreases your credit score that month. And you may experience a 25 to a 35 point decrease because you closed it.
Wow.
Yeah. So if you're going to do a balance transfer, obviously you're going to choose the right credit card company to go with. And you're going to make sure, because you want to make sure that if your credit limit is 10,000 and you're transferring a balance, that you're not going over 30% of that limit. Right?
Okay.
You got to think about all these things. So make sure that your limit obviously is more than enough to be able to transfer that balance, and you're still below 30% of that limit.
See, when I would do that, I would do it all the way up to the point where the fees. Okay, so I was actually hurting myself. I should have.
So not only did you hurt yourself because the account that you transferred from closed, then you hurt yourself again because the balance was over 30% of your new limit. So you hurt yourself twice.
Got it. Well, I kept them open, and it's funny. I now have like all these 15 like non-active accounts. Like, luckily, I was able to finally get myself out of that hole, but it did take a while. And I think it's one of those things that you just have to, commit to it. Don't try to. Because I often think sometimes when people get new credit cards, they think, oh, well, now I've got $10,000 more to spend. I think one of the things is you have to sort of make that decision for yourself and say, you know what, today's the day I'm going to stop going into debt. I'm only going to pay for things, that I can afford, or buy things that I can afford, and kind of, because if you don't change your habits, it's not going to actually end up helping you in the long run.
100% agree with that, Lindsay. So credit really is only there to help you increase in your assets. So really, revolving debt is not to get into debt. It's just to help you establish better credit so that you can purchase property, build a business. That's really the goal.
I have one question. So when's the best time to get a credit card? Because I know we hear this from our clients' parents and things like that they don't want their kid to get a credit card, and I say, well, get it for things that they can buy and they're buying regularly and just pay off at the end of the month. What are your thoughts about just starting to establish a credit history instead of relying always on your parents?
The moment you turn 18.
Okay.
Because of the fact that either that same year or even the year prior, they've already been a student in college. So they are starting to establish credit with their student loan providers, but they don't have any other credit. The moment they turn 18, they're able to apply for a revolving debt on their own is when they should go ahead and start credit. Now, there are parents where they'll add their children to their revolving accounts as the authorized user, even as early as 16 years old. And you can do that. There's no age limit if you're a parent and you're adding your children to your card as an authorized user. But be very careful, because credit is if I say just as important as money, but it's actually more important than money. Credit is everything. So if you do that as a parent, just be mindful that your balances are low, your payment history is positive, and you're only doing it to help establish their credit history. So by the time they turn 18, and they're 16 years old, and you do that and they turn 18, their scores are over 700. They have excellent credit. And then you teach them how to build credit on their own, like teach them at an early age. I will put this out there just because I'm here with you today, but I have a book that's available with Amazon called Credit Repair, Real Answers to Your Credit Problems. You can purchase it through Amazon. That book right there, if you just keep it for your household and just have your kids read it, when they're of age, I promise you it will help them relieve a lot of stress that comes with finance. regarding every topic: student loans, credit cards, car loans, everything, how to establish credit. It talks about everything. So consider reading that book.
That's great. Yeah. And we'll add a link to that when I send out, the replay video for this for you to share to other people that may not have had a chance to join us today. One last question. Are there still advantages to putting 20% down on a home purchase?
The advantage is obviously that the loan amount that you're borrowing decreases, because the more down payment you put on an actual mortgage loan, the balance will decrease because of that. So that's advantage. Obviously, if you decrease the balance, then you're obviously decreasing the, the term of that loan, which when it comes to interest, you're decreasing the interest payments you have to make if the balances are lower. So that's the advantage. But my honest opinion, because I was a mortgage banker, it's not necessary. There are government loans available through FHA, Federal Housing Authority government loans, that will give you up to the 97.5% financing with just a 3.5% down payment. And right now, I have a banker that I work with where he's qualifying clients, if they're debt-free, of course, and they have positive payment history with their debtors that are active. He's qualifying them with credit scores as low as 550 right now. Yeah. So I don't recommend it unless you want to. It's your choice. And then there's VA loans. So if you were a veteran, you can get up to 100% financing through VA. So there's so many options.
I always think, a dollar today is going to be worth less than a dollar tomorrow. I'm not sure if that thought process is, but I think like kind of cash is king. And so if there's a way that I can keep on to my cash as little as possible. Again, I'm not a finance expert. So, and I said one last question, but we did have one more time in. Go ahead.
There's truth to what you just said.
Sorry.
There's truth to what you just said about cash being king. But think of it this way, if you can just think of it in a different way, that when you purchase property, most people don't have cash to pay a mortgage off in full, right? They have to borrow from a bank. So if you're thinking of it as an interest type of savings where you're paying your mortgage, knowing that it's building interest, it's building escrow, and that cash is king.
Right. Yeah, that's good. And you're king of your castle because now you have something to show for it.
Exactly.
Okay, final question, I promise. This one just came in. How long should you keep the other credit cards that I think this is related to the balance transfer. So after you've transferred a balance, how long should you keep those other credit cards open on your credit history? Currently, I kept all of mine, even though I don't use them.
Exactly what Lindsay just said. If you never use them, just leave them. Eventually, the creditor will close it. I mean, sometimes they don't. They'll leave it open with no activity, but sometimes they will. They'll close it out because there hasn't been activity within the last 12 months or 24 months. They'll just close it out on its own. But just leave it. Let them do that, because if they close it out, it's less impactful than you closing it out. So just leave it at a zero balance and don't borrow from it if you feel like you don't need to.
Awesome. This has been incredibly helpful. For me personally, I just love learning about new things related to, all the things that are going on behind the score. I'm pretty competitive. And so seeing my score go up and up and up every time I was paying off something, it was really, motivating for myself. And so I value the work that you do because I do think it's incredibly confusing and people, don't really like talking about money. I think it's, you get a bill in the mail, if it's a medical bill or anything else like that, it just seems like they continue to pile up. But what I've learned through you talking is that's not, don't just let them pile up. You need to kind of just pick up the phone, call people, and you might actually be able to save some money. I mean, when you said you could, ask them to like settle 50% or like 50 cents on the dollar, like I never knew that it would be that much. So I think that's super valuable. So if you need somebody to fight for you, you've got Wanda, just call her up, help me, Wanda. And
I can help you fight those creditors. Hey, I want to mention one more thing before we go, because I have a feeling that in the replay that some people that are going to watch are going to be disabled. So if you have any disability whatsoever and you're getting, Social Security from your local state, there are options when it comes, especially if you have student loans, there are options to get those student loans completely forgiven.
Wow.
Yeah. So
how does that work? And
you just contact your provider. They may ask for proof of your Social Security income. but send them that proof that you are on disability Social Security. And the moment they receive that proof, your complete balance will be forgiven, especially if it's a government loan.
What?
Mm-hmm.
And is this if you acquire a disability after you went to school, or is this for anybody?
It doesn't matter when. It doesn't matter when.
I think this is like the secret sauce that you just revealed. I had no idea.
Yep.
And I can think of several people that, more and more people with disabilities are graduating from college every day. So I think that this is really interesting. Thank you for sharing that.
Also, another tip, if you have medical debt, regardless if it was because of disability or not, and you've lost your job, you're having a really tough time financially, and you're not getting unemployment, contact the hospital, speak to the billing department, and see if you can get your medical debt forgiven.
Wow.
Yeah. So you'll let them know, because they're going to ask for proof, obviously, of all of your debt versus your income, if you have any. If you don't have any, obviously that's easy to prove. There's no income coming in. But they will look at your application and may consider completely forgiving your medical bills. Or they have a program where they'll put you in some kind of program where you can make a very small monthly installment that's affordable so that your debts remain within the hospital and not in a collection agency or a third-party attorney. So consider contacting anyone that you owe and right away ask if they have any kind of debt forgiveness available due to your finances or your status with disability.
Awesome. Yeah. Wow. Well, thank you, for your time. I've really gotten, excited to get to know you, and I think that you'll, we help people at Avocations get jobs, and one of the things that comes with jobs is, the desire to do more, to earn more, to buy more, to build a life for yourself. And I think credit is a very important tool in that process, but you need to be able to manage that tool effectively. So I think just even talking about it more often, you've given me the confidence to start asking questions and helping people ask questions for the things that they might not know. So thank you.
You're welcome. Thank you for this. I appreciate it. Thank you for joining us today. And I hope to be able to do this again in the future.
Awesome. You guys have a great afternoon.
Bye.